This is the Asia Trade. I'm Paul Allen in Sydney, where the markets have just opened.
I'm Haidi, Stroud-Watts. The top stories this hour. Well, Asian stocks are set to follow Wall Street lower as traders trim exposure to US risk assets ahead of the Fed decision. In this region, the Bank of Japan expected to hold its key rate today.
Vladimir Putin declines President Trump's bid for an immediate ceasefire in Ukraine, agreeing instead to limit attacks on energy infrastructure.
Plus, Xiaomi raises its EV sales target after posting the fastest revenue growth since 2021. We'll get more on that outlook, speaking exclusively with the Vice President and CFO Alain Lam. Let's get you straight to these markets with Australian stocks just creeping online in that staggered start to the session. We are seeing not a great deal of movement as we sort of get established there, but we have really that expectation that we'll see a little bit more edging higher there, given that we've extended that rally to a three-day winning strip. It could be a little bit more tepid across the region, though, today, with Asian stocks expected to track some of that weakness on Wall Street as we get into the Fed, but also more critically, we get into the Bank of Japan decision today as well. Not expecting a move from the BOJ, but certainly a lot will be depending on the guidance that we get in that press conference following the BOJ announcement there. Nikkei futures just sort of treading water at the moment. Dollar yen just under that 150 level, Paul.
Yeah, we've got US futures looking kind of flat at the moment. It is, of course, Fed decision day coming up later this week as well. Not expecting any change, obviously, but we'll get a new dot plot. We'll be watching that very closely. But it was a rough ride for US markets today, snapping that two-day rally. Mega caps hitting the lowest since September, and a Bank of America survey shows investors slashing holdings of US equities by the most on record. Crude prices also slipping, never mind the collapse of the Gaza ceasefire. We'll talk about that in a minute, or the US threatening the rebels attacking ships in the Red Sea. Some of these macro factors are proving stronger. We've got Woodmac seeing Brent averaging $73 this year due to OPEC production increases and US tariffs. And President Vladimir Putin has declined Donald Trump's bid for a 30-day ceasefire in Ukraine. But in a call with his counterpart, Putin did agree to limit attacks on Ukrainian energy infrastructure. Bloomberg's Michael Heath joins us now with more on this. Michael, was there any difference in the US reading of this meeting and the Russian reading of this meeting?
Yeah, Paul, it was interesting, the readouts. There was a slight discrepancy there. As you mentioned there, in the Russian readout, they said that they'd agreed not to target Ukraine's energy infrastructure. In the US readout, they said that Putin had agreed, Russia had agreed not to target Ukraine's energy and its infrastructure. In other words, that it wouldn't attack bridges and these sorts of other areas. So that is significant. And one of the reasons that Russia sort of wants to take energy infrastructure off the table is that Ukrainian drones have been targeting Russian energy assets and reasonably successfully there as well. And obviously, energy is the key source of income. It's the lifeline of the Russian economy. So it doesn't give Ukraine a lot there if Ukraine was to agree to it, but it certainly would be a benefit to Russia. But just in general, in the meeting, as you mentioned, I mean, it was quite a disappointment what came out of there. I mean, President Trump's been very strong on his relationship with Vladimir Putin. That he thinks that Putin does want peace, but Russia has really just reiterated its statement that for there to be peace, Ukraine. That the West should cease all arms shipments, all intelligence, and basically, and Ukraine can't call up anyone else to their military. I mean, very, very maximalist demands there.
We're also getting some comments from President Trump speaking in a Fox News interview saying that they do want to get the war over with, that they had a great call that lasted almost 2 hours, that the ceasefire would have been tough. Russia has the advantage, and just sort of giving, I guess, some sort of commentary around those conversations there. We didn't talk about aid at all, but all of this speaking, of course, about that conversation with Vladimir Putin on the phone in a Fox News interview. Mike, this comes at a time we're also now seeing renewed offensives and violence in the Middle East as well, right? It's not just the complete, falling apart of the Gaza ceasefire or the pause, but also a number of other offensives against Iran and its proxies.
Yeah. I mean, just before we go to the Middle East, it was interesting. So from the Russian side, it almost looks like they they're sort of more inclined to try and restore the US-Russian relationship. That's what they want. And they sort of want to keep Ukraine to the side. And the US has sort of got this reverse attitude. So that's going to be interesting how that plays out. But yes, I mean, look, the Middle East, it looks like it's exploding again. The ceasefire has all but broken down. We saw late yesterday in this part of the world that Israel resumed strikes there. And they're basically saying that because they couldn't make any progress in terms of Israel's demands of releasing the remainder of the hostages and Hamas standing down and leaving office, that this is that they're going to renew attacks. It's hard to see what they'll gain there. On one hand, what we did see during the truce was that there are quite a few Hamas militants still around. We saw those propaganda displays when the hostages were released, where they had to make these statements praising Hamas, etc. So Israel's probably got targets on these guys, but otherwise the area is sort of in rubble, and all of the conflict we've seen before that hasn't resulted in the release of hostages or anything like that. So it's really, really worrying times now.
Yeah, and at the same time, it's interesting to see the US ratcheting up the pressure in the Middle East, particularly on Iran, at the same time looking to step back in Europe, where it's traditionally led. And this includes maybe ceding a few top positions in NATO. Yeah.
Well, I mean, because President Trump at the start looked like he was sort of open to a deal with Iran. I mean, there was talk about whether he'd return to his maximalist position. He'd sent this letter to Iran's supreme leader. But now it seems from his statements, and we have to be careful with this, but that the US is going to hold Iran responsible for any attacks on US ships from the Houthis, which the US is targeting now. They're trying to sort of clear up that waterway so that the trade can go through the Red Sea and the Suez Canal. So, very, very interesting, and the potential for the US to sort of cede the being the head of NATO. This is a position that Dwight Eisenhower basically held before he became president. When NATO was formed after the end of the Second World War, and in a sense, it's sort of more of a symbolic thing, but it really does speak to the US. Saying to Europe, you're on your own in a way here, and we're not going to be central to this, and that Asia and I guess China is more their focus. So we're seeing really, really significant tectonic shifts going on at the moment.
Those shifts could create, I guess, both a headache, but, in a lot of people's views, an opportunity for Beijing, right? President Trump now talking about this dynamic, saying that President Xi would like to get along with us. They've had their own discussions with China's President Xi. And they don't want Russia and China to get together, but we are going to be friendly with both Russia and China, and talking about, wanting to resume some trade relations with Russia as well.
Yeah, well, I mean, this is the thing. One of the issues that's been discussed is that sort of President Trump's strategy is to pull a reverse Nixon, the idea being that you could sort of draw Russia away from China and thereby isolate China a bit more. But the conditions are so different to that time. I mean, in the 70s, you obviously had China and Russia and the then Soviet Union having skirmishes on their border, and China was a very extreme, regime at that stage. But it was a real deal of convenience there. China has kept Russia afloat basically since its invasion of Ukraine in Moscow, etc. All we see is Chinese cars, and the trade relationship is massive. There's just nothing in Russia. It's not in Russia's interest in any way, shape or form to pull away from that. What Russia would like to do, I think, very much is to regain a little bit more balance where it can sort of shift between China and the West to give itself more manoeuvrability. It's got none at the moment. It's completely reliant on China. But the notion that the US would open up, resume trade with Russia and it might draw China away, I think is a fallacy. I mean, the trade relationship, the economic relationship between the US and Russia is very, very small. It's Europe that really holds the key there. And Europe has been very hard line on Russia and Ukraine, and I don't think it's going to reduce any sanctions there until it sees a proper peace.
Bloomberg's Michael Heath there, with so much going on when it comes to geopolitical activity at the moment. And of course, investors are also looking ahead to their bread and butter rate decisions from the Fed, the BOJ today in Asia. Fresh policy signals amid economic and ongoing geostrategic uncertainty as well. Our Bloomberg MLF strategist Mark Cranfield joins us now for more. And this, as we kind of saw that brief respite, at least for the sell-off in the US, but there's a lot more volatility, it seems, or potential for volatility in these markets.
Yeah, really the key for traders today that comes out of the FOMC really is how Jerome Powell interprets the job situation. So traders are not really expecting much of a change from the dot plots. They assume they're pricing for 2 interest rate cuts this year. Traders are expecting the Fed to pretty much keep the dot plots the same, and they expect a lot of neutral language when the statement comes out today. But the press conference from Jerome Powell will be much more interesting. How will he respond? There's bound to be questions about what the US government is doing in terms of reducing jobs. They're laying off people. Musk's Doge department is quickly trying to reduce the numbers to save money for the US economy. Got this target of reducing costs by $2 trillion. A lot of that will be job losses. How that feeds into the employment situation going ahead is very much what traders want to know from Jerome Powell. They want to see whether or not he's already concerned or whether he keeps to the same mantra that the US economy is fine, it's doing very well, we're in a good place. They want to see any chinks in that armor at all, and how quickly the Federal Reserve may respond if the unemployment rate starts to drift higher. It's 4.1 now. It could be drifting towards 4.5 or even higher over the summer. It's that the Fed may need to respond to, and that's what traders are watching very closely to see when the Fed is ready to do something about deteriorating employment situation. Whether we get that today or not is very important for what happens to the bond market and the US dollar in the near term. Of course, the news out of Europe that Germany has got a first stage of approval to spend more money is very supportive for the euro. But there could be a double whammy. If we get any hint of dovishness from Jerome Powell today, that will be very damaging for the US dollar.
Mark, ahead of that Fed decision, we do, of course, have the Bank of Japan handing down its decision. No change expected there either, obviously. We've got a situation where wages and inflation appear to be playing ball. But how about the great variables, trade, tariffs? How's that going to cloud the picture for the Bank of Japan?
It's actually politics that is the key for the Bank of Japan today. You can already see that Prime Minister Ishida is under a bit of pressure here. He gave away some vouchers. His rating and him and the cabinet, the ratings are deteriorating very quickly. And even the previous Prime Minister has admitted that he did the same thing. So suddenly, the situation is back to where we were last year. The Bank of Japan had to tread very carefully. After they raised interest rates in July, markets tanked in Japan. They got a lot of criticism for their rate hike, and they had to stand back and wait until January, a whole 6-month gap to raise interest rates again. They go into a similar situation today. They've raised interest rates in January. The market was expecting they might go again in June. That's looking increasingly more difficult because the political situation is so cloudy that the Bank of Japan will be wary to do anything. And traders are now pushing back expectations further. Japan has to have upper house elections in July, so that could rule out that as well. We may now be looking at the third quarter of the year before the Bank of Japan is able to raise interest rates again. That's why people will be watching the press conference very carefully to see from which angle Ueda is coming from. The governor's got a very difficult balancing act to do here. He wants to get on. He wants to raise short-term interest rates to 1%, but the political situation is making it very difficult for him. So people may be expecting that today he signals a long game, that he has to stand back a bit and say a lot more patience is needed. Even though the wage increases are going in his favor, it might be very difficult for the Bank of Japan to sound as though they can raise interest rates in the near term. It may well be pushed back to much later in the year.
All right, Bloomberg. MLive strategist Mark Cranfield there. Still to come on the Asia trade. Big US banks swinging the axe. Morgan Stanley planning to cut about 2,000 staff this month, while Citi slashes executive bonuses tied to its turnaround plan. We'll have the details of that coming up. This is Bloomberg.
Well, it is Bank of Japan decision day. Manage expectations, though, when it comes to a decision, though, because we are not expecting anything other than a hold. Traders at the moment, these markets are seeing a high come September. And we continue to see the trajectory moving in the right direction, right, when it comes to the data. Wage growth data, CPI data, all continuing to come in pretty hot and moving towards the right direction. But after that third hike, the Bank of Japan is likely to wait until summer before it next raises rates, according to these economists that we've surveyed. The market market pricing for that first hike to come in September. So today we are expecting that target rate to be held at 0.5%, but it's really going to be key in terms of what we hear from Governor Ueda at the press conference and the communication and the sort of groundwork being laid for that next move. Let's bring in now Ayako Fujita, Chief Japan Economist at JPMorgan Securities. Ayako, what will you be wanting to hear from Governor Ueda, given that a lot of the data points, including crucially inflation, continues to trend in the right way?
I think actually BOJ will maintain actually its policy course to gradual rate hike, so he will certainly actually reiterate that actually they're going to continue to hike despite the rising global uncertainty. So the focus is pretty much actually on the condition for BOJ to lay out that actually what kind of data points they are watching for to deliver next slight hike.
I do wonder how much global uncertainty is going to play into sort of modelling for the Bank of Japan, right? Particularly as we still see that element of weakness for households that, despite these wage hikes, are still trying to keep on top of inflation and build that confidence.
Yeah, I think certainly global uncertainty is a risk for BOJ. But unless the global economy falls into the recession, it's going to be very difficult for BOJ to turn to more kind of dovish stance. And because the inflation so far has been of course the initial point was pretty much driven by global inflation, but the recent inflation in Japan is pretty much domestically generated. And the household has been very much stressed with higher inflation, so it makes more sense for BOJ to keep its course of the gradual rate hike going forward. So global risk, global uncertainty is clearly the risk, but BOJ need to deal with domestic inflation risk as well.
Yeah, I mean, for economists, Japan watchers, central bank watchers, it is exciting to see inflation taking hold in Japan, but it's an unfamiliar scenario for a generation of Japanese consumers. Do you anticipate any consideration or support being given to them?
I think, no, of course, the people has been totally freaked out with high inflation, but, let's think about, the consumer has been consumer sentiment has been depressed because of high inflation, and therefore despite strong wage momentum, consumer sentiment has remained quite weak. So for BOJ, it probably makes sense to maintain its policy course to gradually hiking rate to contain inflation pressure going forward. And because recent wage momentum is quite strong, and this is clearly the inflation upside risk going forward for Japan.
That has become a political question, though, as well. And as we heard from our correspondent Mark Cranfield earlier, there is going to be an upper house election in Japan soon. The Prime Minister is very conscious of his approval ratings as well. How is the fiscal side of things making it difficult for the Bank of Japan to normalize policy right now?
I think, the point the general public has been frustrated is more inflation and persistent weakness of the yen rather than higher interest rates. So general public are not very much concerned about having higher policy rate. So I think even from political point of view, it probably makes sense for BOJ to keep insisting that they are willing to contain inflation. That is more kind of beneficial for politicians as well. So of course the timing of upper house election is a little bit tricky part, but I expect BOJ to deliver rate hike ahead of the upper house election. So probably June is likely the timing for BOJ to deliver rate hike to show their willingness to contain inflation.
So much of the uncertainty comes from whether it's reciprocal in terms of what we see with global trade tariffs and Trump trade tariffs, right? What is your kind of forecasting in terms of the broader impact on the Japanese economy, and how much dry powder the Bank of Japan might need to keep for that contingency?
The tariff issue is a little bit tricky part for BOJ because, of course, tariff is a kind of downside risk for global growth and also on Japanese growth as well through actually weakness of the global economy. But at the same time, actually, tariff is also a factor for inflation upside risk. So, central bank really need to deal with this both sides of risk. So, which means that actually, I don't think actually, that tariff risk, of course, until actually the tariff actually significant downside risk to materialize, I think it becomes still bit difficult for BOJ to actually change the course of the gradual policy normalization. So it's kind of actually the tariff risk is BOJ may use tariff risk as a factor to shift the exact timing of rate hike, but overall cost may not be changed actually despite of this tariff, just the risk of that tariff.
All right, Ayako Fujita, Chief Japan Economist at JPMorgan Securities Japan. Thanks so much for joining us today. And subscribers can also turn to the Bloomberg for more on the BOJ decision coming up later. You can go to TLive Go, TLIV Go, get some commentary and analysis from our expert editors. More ahead on the Asia trade. This is Bloomberg. We'll be watching shares of Xiaomi later in Hong Kong after it posted the fastest pace of sales growth since 2021. The Chinese tech giant also raised its EV delivery target for this year. For more, let's bring in our tech reporter Annabelle Drewlers. So, Belle, we were expecting strong results. Xiaomi delivered.
Yeah, that's right. I mean, it's really a vindication of the strategy that they follow of human, car and home that is paying off in a pretty significant way. Just recapping some of the numbers here. So in 2024, they returned to the high speed of growth, rather, both annual revenue, net profit reaching new historical highs for the business. As I said, there's sort of those three different categories that we can dive into, but we can kick off with EVs because you can see here, taking a look at the SU7. But essentially, this is a vehicle lineup that's the Ultra there actually, but the SU7 was launched in April of last year, and in that period since they managed to deliver just under 140,000 vehicles for 2024. 2025 they're getting even more ambitious for this, so that the production target has been raised to 350,000 vehicles. Actually, that's more than even our Bloomberg intelligence team thinks is possible for them to bring online, but still they're sticking with that target of 350,000 deliveries. It's going to be split between the SU7 Ultra. You've also got the SU7, as I said, sales started in April of last year, the Ultra at the beginning of 2025, mid-year as well. There'll be another category of vehicle, the YU7, that's going to be competing or going head-to-head with Tesla's lineup as well. So very ambitious numbers, as I said, in that EV segment in particular.
But what else was kind of interesting out of those numbers?
Yeah, I think as well, what was really strong was the smartphone sales. So Xiaomi's following a premiumization strategy where they're essentially trying to sell higher priced devices, and so they did make some gains in that in terms of that category, the 4,000 RMB plus range. They also lifted the average selling price for the device as well. IoT or Internet of Things, that's where they're selling home devices. Again, really strong sales there, benefited strongly from the subsidies and the trade-in programs that are in place.
Annabelle Drewlers, there. We'll get more on the outlook for Xiaomi in the next hour when we speak exclusively with the Vice President and CFO, Alain Lam. More ahead on the Asia trade. This is Bloomberg.
All right, we are awaiting the start of a press conference from SpaceX. The astronauts who were meant to be up at the International Space Station for 9 days ended up staying for 286 after the Boeing Starliner capsule they were supposed to return and malfunctioned. Well, they're back. They splashed down in the Gulf of America a short time ago, about 20 miles off the coast of Florida. So Nick Hague, Alexander Gorbanov also in the capsule, but Butch Wilmore and Sonny Williams, who had been in space for much longer than anticipated, now back on Earth. waiting for that press conference to start. Let's get to Bloomberg senior editor Chester Dawson. Meanwhile, he's been following this highly anticipated return journey back to Earth and joins us now. So, Chester, what sort of spirits are Butch Wilmore and Sonny Williams likely to be in? And are we expecting them to have any complaints?
Well, I imagine the first emotion is relief after making it safely back and being up there all those unplanned months. We did see them, as I think we showed in the opening footage, flashing smiles and giving a thumbs up as they were wheeled out on stretchers for their very routine medical checks. And we do hope to hear from them at some point. But it's been a long, strange trip, and I'm sure they're very glad to be back home.
It's also sort of put the spotlight in a somewhat embarrassing way when it comes to Boeing, right? What is the state of play when it comes to the space businesses that we're talking about? And does this change the narrative when it comes to the competition too?
Yeah, that's a very good question. I mean, this was a big embarrassment for Boeing. They went up on a Boeing craft that had been in the works for years, decades really, and had to be retrieved by a rescue craft, that was put up there by its biggest rival, SpaceX. So, there's a lot of questions that remain about the future of the Boeing space program, and also, the reliance of NASA and the entire U.S. space program on SpaceX. That's become a real point of debate, and with all of the controversy over Elon Musk's role in the government and his space company's dominance over the U.S. space program, it really does pose some interesting questions for NASA going forward.
There's also interesting questions around the duration of the stay. I mean, we've heard from Elon Musk saying, well, he offered to bring them back earlier, and you see the word astronauts stranded in inverted commas. Can we have any more clarity on whether or not they were stranded and how intentional this extended stay was?
Well, wouldn't we like to know? We've of course asked NASA, and they've been coy or diplomatic, choose your expression, about refraining from a confirmation as to whether Musk's claim is indeed accurate. There may be, basically the head of the commercial crew program at NASA had said that they looked at a range of options and worked with SpaceX to determine the best time. So I don't know. I suppose we might learn more of that, maybe even from the astronauts themselves. But I would guess that it's really in nobody's interest to, except maybe for Elon Musk, to draw that out. I mean, I think that it's very inconclusive, and whether we ever get to the bottom of it, I don't know.
Bloomberg's Global Business America senior editor Chester Dawson there, as those astronauts finally return back to Earth. Let's take a look at how we're trading when it comes to just about 35 minutes into the start of the cash trading here in Australia. We're seeing quite a bit of downside there. Really kind of muted trading expected across the region, given that we are waiting on the Fed. For Japan, we're waiting on the BOJ as well, with no change in the rate setting expected, but certainly commentary around the path forward expected from Governor Ueda when we get to that press conference this afternoon. S&P futures looking pretty flat at the moment. One stock we're watching is Maya here in Australia, sliding the most in about 2 months. The first half income declining there, as some of the trading conditions are still remaining questionable when it comes to the consumer sentiment side of things here. Well, Bloomberg has learned that Morgan Stanley is planning to cut about 2,000 employees later this month in its first major workforce reduction under CEO Ted Pick. Some more details now from our finance editor, Adam Haig. So what do we know about these cuts? What does it tell us about, his priorities? Is it part of the standard process for these firms, or is it something that's more structural?
Well, I think it is important to note, Heidi, that this is the first really under Pick. So it does give a clear signal to what he's trying to do here. And 2,000 is still a meaningful number. Obviously, you have a huge workforce, so there's only a small percentage of that. But it is coming before the end of this month, we expect. And one other notable factor in this is it's not going to impact advisors, right? I mean, Morgan Stanley has about 15,000 financial advisors across the business, and it's important to note that this won't include that. So it gives you some sense of what he's trying to do here. But of course, a lot of what we've seen in recent months at many of the big US investment banks, and obviously with Morgan Stanley's focus on wealth management, is just how they are changing to the uptick in activity recently. And it's still a little bit too early to tell. We've obviously seen markets perform with lots of volatility, which has increased some of the trading revenue for the investment banking businesses and equities and places like that. But I think still there's quite a lot to be done. I mean, Ted Pitt was very clear when he came in. The costs and getting a grip with some specific areas of the banks were one of his main areas of focus. And I think really what we have here is one early example of what he's going to try and do here.
Well, we've got Citigroup belt tightening as well, slashing executive bonuses. How's this likely to sit with staff and investors, and how does it fit with the picture in terms of what Jane Fraser is trying to achieve?
Yeah, well, this was a special bonus pool around senior executives, and it was only ever going to last for a finite amount of time, and this is kind of the last in a tranche of three here. So, there's plenty of staff, I'm sure, at Citigroup that are still reeling from all the changes that are happening. I mean, Jane Fraser has been criticised quite heavily and quite publicly for some people in the market who basically say that she's not performing to the degree that they expect in terms of the turnaround strategy, in terms of focusing the business into the areas that she's chosen to focus on. And so there is still a little bit of that playing out, and there's still a sense that we need to see further changes in Citigroup and an acceleration of the turnaround plans. So that's one element really, in performance and how you reward staff. And of course, there's been a little bit less attrition within banks of late, but I think it's important to note that this was, the last part of a change in bonus structure, and of course that's coming to an end now.
All right, finance editor Adam Haig there. Let's get you to that SpaceX press conference now. Of course, Sunny Williams, Butch Wilmore returning to Earth a short time ago, splashing down off the Florida coast about 6 p.m. at New York time. We very much look forward to hearing their story. Let's go and have a listen in to this press conference now.
We look at the handover time on orbit between the incoming crew and the departing crew to make sure there's enough time for activities to be accomplished before the departing crew leaves. We do have the benefit of having NASA astronaut Don Pettit remaining on board. He'll be coming home on Soyuz in April, and so he'll continue the handover with the crew. We also look at the vehicle traffic, the vehicles coming and going. And when you pull all that together, the International Space Station program, the Commercial Crew program, and SpaceX came up with the plan that we just witnessed. The Crew 10 launch last week, the docking over the weekend, the undock early today, and then the landing that we just witnessed. So just an incredible amount of inputs that you get to pull all that together in order to have a successful operation. I want to tell you, I want to thank the Crew 9 team and the ground teams for their dedication to excellence, their resilience, their flexibility during this expedition, everything they did to have a successful expedition, as you have all witnessed. SpaceX has been an incredible partner for us. And it shows the benefits of the commercial public-private partnership that we have. So they just been a huge, great partner throughout all this. Crew 9, in addition to the spacewalks that many of you witnessed, they performed just about 150 experiments on board the International Space Station with over 900 hours of research. And the work we do on the International Space Station benefits the nation, benefits people on Earth, and are the building blocks for going back to the moon and to Mars. So Nick, Alexander, Butch, and Sunny, welcome home. On behalf of NASA, I want to thank the administration. I want to thank all the work of the NASA teams and all the work of the SpaceX teams. And so with that, I'll hand it over to Commercial Crew Program Manager Steve Stitch.
Thanks, Joel, and thank you all for being here. Greatly appreciate your interest in the Commercial Crew Program and also human spaceflight. Of course, as you know, it's been just a huge week for Commercial Crew. The missions, I think, sometimes seem easier than they are. If I just step back and think about all the challenges we had to launch Crew 9, moving to a different launch pad, adjusting the seats and the crew training. And then, over the weekend, once we docked crew 10 safely, looking at the weather patterns, finding this great opportunity that we landed at today, adjusting the timeline. It's never easy. Spaceflight's always dynamic. Sometimes it seems like things move from step to step to step, but there's usually different paths along the way. So the weekend was culminated today with the landing of Crew 9. We dragon splashed down at about 5:57 p.m. off the coast of Tallahassee. That's our first commercial crew program landing at Tallahassee. We've had a couple cargo flights land there. And now it's great to have Crew 9 and the Freedom capsule back home, and its fourth flight is now in the history books. Of course, we're overjoyed. I watched every crew member come out of the vehicle today. Post-landing, it was great to watch Nick, Sonny, Butch, and Alexander come out of Dragon and smile and wave as they came out of the vehicle. We'll get them, they're on the ship now, we'll get them back to meet the NASA aircraft and then back to meet with their families. If you watched the weather today, it was incredible. Clear skies, real low winds, maybe 3 or 4 knots of wind, and really calm seas. You could see the dolphins swimming around the capsule, which was kind of incredible. SpaceX had a nice drone aircraft flying around and taking footage, and that was just incredible. As I said, the ops team just did a phenomenal job over the weekend, pulling in the landing to get the crew home sooner and take advantage of this great weather opportunity. Really appreciate the versatility of SpaceX, the ISS program, commercial crew program, and the flight ops team in planning out the timeline, looking at the crew's workload, determining whether we could pull this off, doing sleep shifting, all those sorts of things that made this an opportunity happen. I also want to thank our partners at the U.S. Coast Guard. They were there on scene, protecting the scene and making sure that it was safe for mariners in the area. The FAA, the Department of Defense.
We'll have to leave it there, but of course a lot of celebration as those NASA astronauts are finally back on Earth after 286 days there. We're listening there live from Houston, Texas, as we had that post-splashdown press conference underway at the moment. More ahead on the Asia trade. This is Bloomberg.
The tariff assumptions we're making, we're now assuming that the tariff rate is going to increase by around 10 percentage points. And so the tariff rate, Matt, in the coming year will be around 13% in our model. Previously, we had assumed around 3%. So those are really the 3 building blocks: the slower earnings growth, largely driven by slower economic activity and a higher tariff rate, and then a slightly lower PE multiple ascribed to the year-end growth for next year.
That's Goldman Sachs Chief U.S. Equity Strategist David Kostin there. Well, joining us now from Tokyo is Warren Wachsberger, CEO at U.S. real estate investment management firm Eldridge Acre Partners. Warren, thanks so much for joining us today. I just want to start off on that issue of tariffs and the trade uncertainty that we're seeing at the moment. Can you give us a sense of how that's creating some uncertainty for you in terms of construction, development and real estate opportunities?
Sure. Firstly, thanks for having me on the program today. So when we think about tariffs overall, we think about 2 competing factors. One is the cost increases if they happen from Canada and Mexico. And so about 40% of a construction budget is hard costs. And of that hard cost, maybe if you have a 10% tariffs, you potentially have a 4% increase in overall costs. So not that big. But on the other side, you've got the competing factor of less demand for new buildings, which obviously pushes prices down. So those 2 competing factors are something that we're thinking about a lot.
So when you're balancing those competing factors, where do you look for opportunities at the moment in real estate?
So for us, we're really looking for opportunities in places where we see long-term structural trends that are very positive, in particular in housing, that are being impacted by the short-term cyclical issues associated with tariffs, inflation, lack of credit availability. And so for us, we see that in housing and in particular providing rescue capital to projects that are in need of additional capital, given that their capital structure may be broken due to these short-term cyclical issues.
Where are you seeing the policy uncertainty hit when it comes to the real estate market and that broad space in the US at the moment?
So I think there's three places where we're seeing the policy uncertainty impact. One is around inflation, so that those inflation stats are obviously impacting long-term rates, which is a benchmark that we utilize significantly when we're looking at the opportunity set. Two is just pure uncertainty. So obviously when there's uncertainty in the system, people are less willing to invest, which for us presents opportunity. And then finally, what we spoke about earlier around tariffs. Are tariffs going to happen or are they not going to happen? And so based upon those three factors, it really presents some uncertainty in the market, which we actually view as an opportunity to invest because investing in early stage recoveries, so in these times of recession, has proven out historically to be a positive trade.
Tell us about what you're doing in Tokyo and in Asia at the moment.
So we spend a lot of time in Asia because we've got a number of Asian investors who are looking towards the U.S. as an opportunity to invest. So one of the things that we hear a lot from many Asian investors is that they were not invested in the market historically, and now they're seeing this as an opportunity to find deals to be invested in the U.S. So when we're talking to these investors, one of the things we hear over and over is the exact questions you asked earlier. How are the policies going to impact our investment, and how does that present opportunities?
You were speaking earlier about some of the uncertainty around the tariff environment. Well, we've got a little bit of certainty. We know that there are tariffs on imported steel from a number of markets. How's that likely to impact construction costs and other costs for you?
So going back to what I was saying, I think the big impacts are going to be steel, aluminum, soft lumber. We obviously get a lot of steel and aluminum from China, soft lumber from Canada and Mexico. And so similar to what happened when tariffs were on board in the prior Trump administration, we insourced a lot of sourcing from U.S. distributors, and that obviously softened some of the blow. But it's certainly an issue that we're closely focused on. But again, as I was saying, about only 40% of building costs are related to hard costs, and a 10% increase translates roughly to a 3 to 4% increase in overall pricing, which is not a huge impact to those building projects.
There's a lot of pressure, both in terms of tariffs, in terms of what the consumer is doing, and also simply structurally when it comes to the US retail space, right? How much retail vacancy are you seeing, and do you forecast more? And I guess the flip side of that is, as we see more and more interest in AI, do you see data centers or the such kind of potentially replacing some of those vacancies?
One interesting thing about retail is retail really didn't have nearly as much supply come online over the past cycle. Post GFC, you really saw a significant stop in retail. And so what we're left today, at least in the US, are the haves versus the have-nots, which went dark. And so we're actually not seeing that big of an impact on the retail. In fact, we're seeing a lot more investors who are looking to be long on retail. Overall, the big things that we're focused on are places where those supply-demand imbalances exist, in particular within housing. I think when we look at housing, depending on which statistic you look at, we're 2.5 to 5 million housing units short in the U.S., which presents a real opportunity to make some investments in places where people aren't investing today.
Warren, really great to have you with us. Warren Wachsberger, who's the CEO at Eldridge Acre Partners there. And sticking with Japan at the moment, we are just getting some data crossing the Bloomberg when it comes to core machine orders as well as trade numbers there as well. Core machine orders rising 4.4% year on year. The estimate was for a gain of 6.6%, so perhaps not quite as strong as expected. That's a decline month on month of 3.5% versus really an expectation of a very marginal decline there. This, of course, course, as we are getting to Bank of Japan decision day, Governor Ueda expected to hold rates, but potentially give some sort of guidance that 1% is the near-term goal there. We're also getting some trade numbers out for Japan as well. Exports in particular coming in at 11.4% year on year. A pretty strong gain, but estimates were for higher of 12.6%. We are seeing an impact of a decline when it comes to imports of 0.7% year on year as well. And looking at that trade balance number as well, particularly carving out the exports to the US rising by 10.5%. And you've got to wonder how that plays into that sort of broader tariff risk, given that we have seen Japan as just one of the Asian economies being targeted potentially when it comes to these trade tariffs. In particular, Japan autos and auto part demand expected to stay quite subdued as a result of these auto sector tariffs from the US, with Japan just also being one of the countries that failed to get that immediate tariff reprieve, despite, of course, that ongoing strengthened relationship in the US-Japan alliance. Paul?
Yeah, we will have the market opening in Japan, of course, in about 7 minutes' time. Seeing a little bit of softness for futures at the moment. It's looking like a risk-off day across the Asia-Pacific following those declines that we saw in the US. US market snapping a two-day rally. A little bit of weakness here in Australia as well. We're off by about 0.5%. Every sector on the ASX currently in negative territory. S&P futures, though, suggesting we might see a little bit of upside tomorrow. Well, JX Advanced Metals is set to debut in Tokyo today after Japan's biggest IPO since SoftBank's mega deal 6 years ago. The metals refiner and chip material maker raising $2.9 billion amid strong demand from investors. Equity capital markets reporter Yasutaka Tamura joins us now for more. So what do we expect for the JX Metals IPO?
Morning. So this would set the tone for Japan's share sales going forward this year. Given the size of the deal, which is the biggest in 6 years. But first of all, the timing isn't very ideal for the company because Japanese stocks fell the most since 2022 last month on a monthly basis, and Japan's IPO market doesn't look as hot as last year this year so far. But so that forced JX IPO to cut the price earlier, but with the cheaper valuation, that attracted solid investors' demand. So that could, send a positive signal for companies in the pipeline. And if the company, performs well today, that would be also another tailwind for the pipelines and also overall IPO market in Japan.
What's so special about this IPO?
So this IPO tested investors' demand on semiconductor area because JX generates and supplies the key semiconductor materials like so-called sputtering target that's used to form a layer on the semiconductor, and JX has about 6% of the global market share of this material, and their clients include TSMC and Intel, so they have nice business and technology for that.
Our Japan equity capital markets reporter Yasutaka Tamura there. We are just minutes away from the market open in Seoul and Tokyo as we wait for the Bank of Japan decision as well. Markets looking pretty muted for sentiment right now. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and taking a look at
Just an hour until the start of trading in Australia. We're getting to the open in Japan and South Korea, Paul. And of course, for Japan, we're looking at Bank of Japan decision day. Nothing expected. It would be very interesting to see what we hear from Governor Ueda, given there are still some cross currents, particularly as we start to watch the sort of political uncertainty and what the implications are there.
Definitely. I think everybody can agree the next move is going to be higher. Policy normalization continues, but when is the question now? And to some degree, the Bank of Japan are boxed in by circumstances beyond its control.
Yep. Let's get you straight to the open there in terms of what we're watching on BOJ decision day. As I said, September is looking more likely there when it comes to when we could see another move from the Bank of Japan. So nothing expected today, but certainly at that press conference, the communications and preparedness being laid out by Governor Ueda will be key. Goldman, for one, saying that wages need to rise further to be able to meet the BOJ goal. They need to rise by at least 3% over the next 2 years for that sustainable inflation target role to be met, according to Goldman. And we do know that one of the sticking points for the economy is really, despite how much wages have risen compared to historical levels, we're still seeing that confidence hit to Japanese households in terms of struggling to keep up with the cost of inflation. The Nikkei 225 just coming online, up by about 0.1% at the moment. One thing that we're watching is where dollar yen goes from here. 149, kind of 50-ish is where we're sitting at the moment. But a move higher above 150 certainly can't be ruled out, given what we could get from the Bank of Japan, but also the ongoing kind of political uncertainty, the pressure that we're seeing when it comes to the Prime Minister, the approval ratings, the potential for further volatility on the political side, we know quite often weighs on FX markets as well and has implications for the Bank of Japan as well. But today we are waiting for that commentary from the BOJ later on this afternoon. Take a look at what we're watching when it comes to Korea, and it is actually all sort of a lot of political news flow there as well. We are looking at President Yoon facing that court ruling, the potential scenarios and impact with the Constitutional Court's ruling really on that imminent on his impeachment. That'll have really wide-ranging ramifications for the economy, for the political environment, the diplomatic landscape, at a time, of course, where there's so much external and trade volatility as well. The Kospi up by about 0.3%, Paul.
Well, we've been trading here in Australia for a little over an hour now, seeing a little bit of weakness on the local index, although pairing some of those losses. We're off about 0.4% at the moment. But pretty much every sector on the ASX is negative, with the exception of energy, which has just turned positive. We'll talk about the oil price in a sec, but take a look at yields there. Not really moving in the Japan session. We did see the 10-year yield dropping 1 whole basis point in the US session. There was also a successful $30 billion auction of 20-year notes as well, but not a lot of movement in yields there at the moment. The oil price, as I mentioned, just nudging a little bit lower. Never mind the collapse of the ceasefire in Gaza and the US threatening Houthi rebels that are attacking ships in the Red Sea. These questions around OPEC production increases, US tariffs as well, continuing to weigh on the oil price. We've got Brent there at 70.46 at the moment. Right, let's get to Audrey Go now, Head of Asset Allocation at Standard Chartered Wealth Management. Audrey, thanks so much for joining us. I do want to start in Japan if we can, because we do have that decision coming up very soon. Not expecting any changes discussed, but when do you think the Bank of Japan's going to be able to tighten next? There's some difficulties for them here.
Yeah, I think for now in this meeting, they'll probably stay pat, given that they have just hiked rates back in January this year. And there is also an upcoming 2nd of April where the US will be releasing their findings on reciprocal tariffs. I think Bank of Japan, in this case, will probably stay pat for the time being until there is some sort of clarity on this front. Our expectation is there's going to be further rate hike in Japan, probably sometime after the second half, during the second half of the year, because if you look at whether is it from an inflation data perspective or even wage gains perspective, that do actually reinforce the case for further hikes, further tightening policies where it comes to economic data. So the timing-wise, I think maybe sometime in the third quarter, if not the fourth quarter, which is something that we'll be watching out for.
You also like the yen in these circumstances as a diversifier amid US growth concerns, and we are seeing the yen continuing to soften here. Do you also prefer Japanese equities to US equities in the current environment?
Yeah, so in the current environment, I think yen could be one of the safe haven assets in the event that U.S. growth slowdowns were to concerns were to further further being amplified for that matter. And the fact of the matter is, if we look at bond yields in Japan, I think bond yields are creeping higher as well, and that should support a rates differential between Japan and U.S. in favor of a stronger yen. I think in the short term, while we are seeing some weakness in yen because of concern over tariffs, concern over some political related situation, I think over the next 6 to 12 months, we do expect yen to trade slightly stronger versus the dollar. And then in terms of Japanese equities, we have a neutral view for now. But if you look at the factors supporting Japanese equities, I think the earnings revision is probably one key area of optimism where we've continued to see upside in terms of analysts revising up earnings forecasts for Japan vis-a-vis in the case of US year to date so far. I think analysts have been revising down their earnings estimates.
As April 2nd looms and the more news flow when it comes to tariffs, I wonder, do you have any sort of strategic hedges to be able to deal with this in terms of sort of liquidity levels, cash levels, any way that you can potentially sort of hedge this as a popular trade?
So we've been telling our clients that, against the backdrop of impending sort of risk from a trade perspective, I think some of the key safe havens our investors can be looking out for is, number one, yen is one of them, certainly the Swiss franc as well. And of course, if you're talking about the defensive sectors, some of the more defensive sectors such as utilities, for that matter, staples for that matter, could also be a bit more, relatively more resilient against this backdrop if trade-related concern were to resurface once again.
I mean, I suppose one of the other diversifiers is that you could look at China, right? Is it compelling to you at all, given that we've seen such a big outperformance of Chinese equities, particularly offshore, versus the US? Because I know that you were still sort of maintaining that neutral.
Correct. Yeah, so in terms of China equities, I think in the short term, the rally that we've seen so far has been pretty robust. So I think we wouldn't be surprised if there were to be any short-term pullback for that matter. I think the way we are playing China is one of a barbell approach, if you think about it, where we have been focusing on Hang Seng Technology since the beginning of the year, and that's done quite well, which is a higher beta trade. And then coupling that with high dividend stocks, which sort of pays investors to wait out for a more sustained recovery. I think that trade has been going well so far, and we would likely to maintain this trade going forward. Another area that we like is probably European equities, where there are some form of a structural reckoning, especially when it comes to the largest economy from Germany, where they have just recently approved a spike up in defense spending in anticipation of the need to maybe stand on their own 2 feet a bit more after some of the complaints from the US. So I think Europe is also one area that we are increasingly more constructive on as well.
Audrey, really great to have you with us. Audrey Go, Head of Asset Allocation at Standard Chartered Wealth Management. Take a look at what we're watching at the moment, and there's one particular mover that we're watching when it comes to the Tokyo session, given that we're seeing that debut there. JX Metals, their shares opening up by 4%, now over 4% in their Tokyo debut, so really above that IPO price there, and one that we're watching very keenly. JX Advanced Metals Corporation, they're opening on that IPO debut. More ahead on the Asia trade. This is Bloomberg. We'll certainly be watching shares of Xiaomi later in Hong Kong after it posted the fastest pace of sales growth since 2021. Let's bring in our tech reporter, Annabelle Jewellers, for more. Belle.
Thanks, Heidi. Yeah, this was really strong numbers for the business. I mean, we had expectations. We had pretty high expectations coming into the Xiaomi results, but overnight they certainly delivered. We saw both annual revenue, net profit reaching new historical highs, and total revenue for the group up 35% on the year. So let's bring in exclusively from Beijing this morning, Alain Lam. He's the Vice President and CFO at Xiaomi. Alan, thanks very much for joining us. And as we said, they're really strong results for Xiaomi for the latest quarter. Lots to like as well. So what stood out to you exactly?
Yeah, good morning, Annabelle. Good to be on Bloomberg again. I think that if you look at our results last year, I think the one interesting thing is all the areas, major areas of our business continue to grow. Obviously, we have the EV business, which is a new business that we started delivering in April of last year. And, in 9 months, we delivered over 136,000 cars. But more than that is, if you look at the smartphone side, we grew our revenue by over 20% last year, right? We gained market share. Our global market share last year was 13.8%, which is 1% higher than last year. In China especially, we grew our market share by 1.7%. And obviously, the premiumization strategy has started to work. Right? If you look at our IoT business, last year was the first year that we exceeded 100 billion RMB in terms of revenue. Right? So, all in all, we put it together, you can see that. And the IoT business grew 30% as well year over year. So all in all, we've achieved very good result. As you mentioned, 35% year-over-year growth. And in fourth quarter of last year was the first quarter ever that we achieved over 100 billion RMB in terms of quarterly revenue. In terms of profit, obviously, we are focused on improving our gross margin. Our gross margin hit, 21.2% in our core business in 2024, which is similar level to 2023. And our EV gross margin was 18.5% for the entire 2024, which for a startup company in the EV business like us, I think is a remarkable achievement. At the same time, we focus on controlling our operating expenses. Sorry. Go ahead.
No, I was just going to say that exactly. I mean, the numbers for the EV in particular, you only launched in April of 2024, and as you said, around 140,000 deliveries. This year, though, the target has been raised to 350,000 deliveries. So what's the strategy for having such a big increase?
Well, I think, look, if you look at the background here, you see a couple of our EVs, right? The red one being the SU7, and then the yellow one, which is something that we just launched, is our SU7 Ultra, which we are selling at a starting price of over 500,000 RMB, right? As I mentioned that, last year, we've been ramping up our production. Obviously, the SU7 was a huge success in the market. I think a lot of investors, a lot of customers like it. We have a huge backlog. If you look on the app this morning, I think the average waiting time for SU7 right now is at least 30 weeks. Right, so that's a huge backlog for us that we need to deliver. In terms of how we are going to do it this year, obviously, you've seen us yesterday raising our target from 300,000 for this year to 350,000 for this year. We need to work very hard to improve our production. Right, so we are happy. We are rapidly expanding our production capacity, and also ramping up our delivering capability as well, which we are very confident that we can achieve that 350,000 target for this year.
How do you go about doing it, though? I mean, do you have plans, for instance, to add on an extra factory? What's sort of the spending or the thinking in that area?
Yeah, look, I think we are running one factory right now in Beijing, which is fully ramped up. We are working very hard to squeeze the extra production volume out of that factory. But at the same time, obviously, we need to continue to expand our production capabilities by adding new production sites, which we're working on very hard right now.
Okay, and any details that you can share on those extra production sites?
Well, look, I mean, I think we'll have that. Well, once those get online, we'll share those with you. But at this moment in time, we're working very, very hard to get more of those online as soon as possible.
All right. OK, thanks for Alan for that one. We'll move then to smartphones, because this is another category. I think it was the 18th consecutive quarter where you were the number 3 globally. What's the strategy here around continuing to increase not just the market share, but also to sell higher priced devices?
Yes, if you look at the smartphone business, I think last year, if you look at the top 3 brands globally, we are the fastest growing among those top 3 brands. So we are as I mentioned, we increased our market share by 1%. If you look at the shipment for last year, it was around 169 million units. The year before was around 145. So we managed to increase our volume by over 20 million units for last year. Right? If you dissect it further, you see that in China, we are able to grow our market share in the premium market. If you look at the 3,000 to 4,000, 4,000 to 5,000, even 5,000 to 6,000 RMB range of smartphones in China, we have been able to increase our market share. So the continual penetration in our smartphone premiumization in China is definitely working. For example, we launched this Ultra product, Xiaomi 15 Ultra, which has been a huge success, and we've seen year-over-year growth over the previous version. So that's in China. The fact is we're also expanding our retail presence in China. So we increase our number of stores to around 15,000 stores in China, which help the market share that we have in the offline market in China as well. In the overseas market, you've seen that we've been expanding our global footprint. We have achieved very high, very good increase in terms of shipment, both in Africa, in Latin America, in Southeast Asia, in all those regions.
Yeah, and just going back to that, the expanding retail presence in China and actually abroad as well, that's certainly the strategy that Xiaomi is following with the bricks and mortar approach. That also applies to home appliances as well. So talk us through, again, IoT, strong numbers in that category.
Yeah, look, I think just we'll spend a minute on the retail stores because we have been able to increase our retail presence and having an integrated stores that put our smartphones, put our IoT products, as well as putting our EVs in. I think it helps a great deal with highlighting the human times home times car strategies that we've been executing over the last couple of years. But also, if you get into the store, you see that you have a wide range of products that we're selling, not just smartphones, not just car, but also IoT products, which help us with our IoT sales as well last year. You've seen that we are expanding very rapidly in the white goods market. We have gained very strongly in air conditioners, washing machines, refrigerators in that category. But also it helps other sales like our tablets, our wearable products, as well as other ecosystems products. So we're able to leverage this increased retail network and sell more of our wide array of portfolio products.
And just on that, because obviously in the latest period as well, and in this quarter, we're still seeing the impacts of government subsidies or trade-in programs. So do you see those gains being sustainable?
Oh, it does help. To be honest, I think it does help us in terms of the national subsidies on smartphones, on white goods, as well as on other ecosystem products. It does help our sales, especially on the IoT side in China over the last couple of quarters. But I mean, as you think about our business, 50% of our revenue in smartphone and IoT products comes from the overseas market. Right? So obviously there will be some incremental boost in China, but if you look at my broader portfolio, right, again, 50% of our revenue comes from the overseas market. So the impact of this national subsidies is not as significant if you think about the overall size of our business.
Mm-hmm. Something that came out in the earnings call, and I was listening for more details, was around CapEx. You did say that it's going to exceed the spending for 2024 levels, but can you give more guidance on exactly what you're planning to spend and also the breakdown? Because I think you've obviously got the spending on EVs, but AI, for instance, is another area where you said, for instance, you also need to improve your AI technology, including on LLMs.
Yes. So if you look at the historical numbers, in 2023, we spent around 7 billion on CapEx. In 2024, we spent over 10 billion on CapEx. And I think that in 2025, the spend will go up. It comes in a few areas because over the last few years, we've built two manufacturing capacity. Number one is our smartphone manufacturing site in Beijing. And the second is obviously our EV capacity factory in Beijing also. This year, we are also starting to work on our air conditioner factory, which we expect to come online at the end of this year. This will be in Wuhan, right? And as a result, we are, spending more and more capex and building new manufacturing capabilities and capacity. So that's number one. Number two, as you mentioned, on AI, I think we also need to invest in our fundamental infrastructure in terms of, the capabilities of handling large data model. And as a result, I think we also need to invest in some additional capex in the AI area also.
And could you give, how much are you planning to spend exactly?
Well, I think, look, Annabelle, I think we will invest more this year, and I think a lot of the incremental increase in capex will go into the areas that I talk about, building more manufacturing capacity, as well as investment in AI infrastructure.
Mm-hmm. I want to talk about the share price rally because, we've tracked it so closely at Bloomberg, and it's been pretty exceptional, the run-up in the stock. I'm interested, as a CFO, are you looking at taking advantage of that in any sort of way? For instance, earlier in March, we saw BYD, for instance, with their major share sale. Would you be looking to do something similar?
We have no plan at this point. I think we have plenty of liquidity. As you see, we have a very healthy balance sheet, very low gearing ratio, high level of cash, and we are generating a healthy level of cash flow right now. So there's no plan immediately to do something like what BYD did.
And last question is on really how investors should also think about Xiaomi as well, because should we be valuing it as a hardware, a software, an internet, an EV maker? All of these different categories have different valuations. So how do you think about the business?
I think the core of our business is really that we are a technology company at the core. As a result, you see that we are investing very heavily in operating system. We are investing very heavily in AI. We are investing heavily in other areas that will enhance this ecosystem of products. So I don't see myself as a single product category. I think we're probably the only company globally right now that encompass smartphone, IoT, as well as EV. But underlying all of those ecosystem of products is the software, is the technology, is the AI, is the operating systems below that. So we are investing, as you can see, last year we spent $24 billion on R&D. This year we're going to spend over $30 billion in R&D. I think that all R&D goes into every single product, and a lot of those synergies between where we're spending and the applications of those technology.
All right, Alan, congratulations again on the results. That was Alain Lam there, Vice President and CFO at Xiaomi Group, and we'll have plenty more ahead on the Asia trade. This is Bloomberg.
Just get you across an alert on the Bloomberg terminal. The Wall Street Journal reporting that activist investor Starboard is preparing to start a proxy fight at Autodesk. Autodesk provides engineering, 3D design and entertainment software and services. Starboard, not happy with the way that the company is being run, has more than a $500 million stake in Autodesk. Autodesk shares off about 12% since the start of the year. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Asian markets are faring. It is a day of significant news flow when it comes to central bank decisions. We've got the Bank of Japan ahead of us, as well as, of course, the Fed. We are seeing some sort of muted advances when it comes to Japanese stocks, up by 0.4% there. The Kospi also seeing some leadership despite those declines on Wall Street, wanting really more clarity from the Fed policy decision in lieu of course, looking for more opportunities in those US markets. Bank of Japan not expected to do anything to move that rate today, but really down to the communications that we could expect from Governor Ueda this afternoon. We're seeing a little bit of downside trading here in Australia after a 3-day rally. Geopolitics is front and centre as well, with President Trump saying that Russia has the advantage in talks to reach a ceasefire in Ukraine. He spoke after Vladimir Putin rebuffed his call for a 30-day truce, but did agree to limit attacks on Ukrainian energy infrastructure. Bloomberg editor Michael Heath joins us now. So what is sort of the dynamics of the game that's being played? We did hear President Trump talking about his fairly extended phone call with Putin.
Yeah, I mean, he said it was a great phone call, and 2 to 2.5 hours. It's a long time they were speaking. From the Russian side, it looks like they're sort of trying to stall on Ukraine or drag it out, but they're very keen to sort of restore relations to some extent with the US. Obviously, there's a lot of, Russia has problems with access to international financial transactions and these sorts of things that the US could make a lot easier for them. And for President Trump, I mean, he obviously always enjoys talking with President Putin, but he really doesn't seem to have made much progress here. Russia offering not to target Ukrainian energy infrastructure isn't much of an offer. I mean, what the Kremlin sort of seems to be looking for here is to get a quid pro quo where Ukraine wouldn't target Russia's energy infrastructure as well, which Ukraine has been doing very successfully outside of its other difficulties on the battlefield. Nothing really has come out of it. I mean, the president seems to be putting a brave face on it. He's always very upbeat on Russia and very positive. But Putin, as was sort of suspected by a lot of analysts, does seem to be drawing this out, and there doesn't seem to have been much movement there after he basically dragooned Ukraine into agreeing to a ceasefire.
There are also some potential changes being flagged in how NATO might be led in Europe as well, and I'm just wondering how that squares away with the US perhaps wanting to withdraw support for Ukraine and Europe having no interest in that at all. Yeah, well,
it's a really interesting one. It's an NBC report, Paul, saying that the US is considering giving up the command of NATO. Now, the US general, or whoever's in charge of that, basically is in charge of organising the shipment of aid to Ukraine and the intelligence provided, basically all of the US support there, and it's a pretty significant position. This is what Dwight Eisenhower, he was the first person in command there after the Second World War when NATO was formed, obviously a former president, and it's had some significant figures over the years. In a sense, it is a degree of symbolism, because obviously NATO is more than the US, but it is a sort of a sign of US commitment to the continent, and giving that up sort of suggests that we're not particularly committed to the continent now, and it really does put the ball back in Europe's court. We've seen overnight that the German Parliament has agreed to ramp up massive spending there on defence, which is much needed, and so this pressure the US is putting on Europe to start stepping up seems to be working. But the US seems to be making clear it doesn't just want that; it wants to get out. It wants to be out of having to be the backstop for those countries.
We're also hearing that the renewed pressure on the Gaza Strip was ran past Washington as well, and so one assumes supported. The ceasefire is obviously now ancient history given the bombardment that we're now seeing, but I wonder what sort of comes after this, given that we know that so much of the population has either been killed or displaced. The Strip itself is, in tatters. What's the way forward, given that we also don't have any kind of post-conflict plan?
It's a really, really good question, Heidi. I mean, obviously, President Trump has sort of almost taken over the public role of the hostages and negotiations. And at one point, the US even spoke directly to Hamas, which was very unusual. And he had demanded that Hamas release the remaining hostages. We know there's one American there, and it's believed to be about 25 still alive. Or warned that all hell would break loose. And Israel sort of seems to have picked up on this as well. And so all hell can break loose. But, we've seen in the 17 months before the ceasefire that not a hostage was, that military force never freed anybody here. So it is, as distasteful as it is, they do have to negotiate if they're going to free these people, unless they're going to condemn them to, to suffering and to whatever's going to happen to the rest of the population in Gaza as well. But there is no obvious end game. And I think sometimes, this is the difficulty with the new administration and perhaps being a little bit unrealistic in what military force can achieve. Israel wants Hamas to disarm. It wants it to leave power, and that's reasonable. But after 17 months of bombardment, as you pointed out, I mean, the strip is rubble now. What more can you do? They also
don't want to work with the Palestinian Authority either.
Well, this is the other difficulty: is that Israel has basically offered no forward plan, and so no one knows where they're going outside of military force, and I think that Arab neighbours would really like to have some idea of what's going forward. There's been various conjectures that an Arab force might come in and with peacekeepers, etc. But whether they'd be prepared to do that without without the Palestinians being involved fairly closely it's difficult to see. So we sort of look like we're at a dead end to some extent here.
And it's interesting, the US involvement in this region as well. I mean, while they're trying to withdraw from the Ukraine conflict and bring that to a close, that the rhetoric seems to be getting somewhat hotter, particularly when it comes to the Houthis in Iran.
Definitely, Paul, and it is interesting because, I mean, America first is an isolationist idea, basically, and that sees, okay, it has China as the threat, and that's what it sort of wants to focus on, or as the main competitor that the US wants to focus on. But yeah, that's this stepping up of the rhetoric with Iran, and obviously the attacks on the Houthis, which the administration says will continue until the Houthis stop firing at ships in the Red Sea and trying to bombard Israel as well. And President Trump sort of made a comment that any attacks on US ships would be seen as as being directed by Iran, which was really quite concerning because while these groups like Hezbollah and the Houthis are proxies of Iran's, it's not clear that it has direct control over them there. So the worry is that this could spiral a bit further out of control. At the moment, it's just targeting the militants and the missile sites, etc. But whether the US can achieve much there, I mean, the reports are that the Houthis aren't using mobile phones anymore, that people have left home and are in caves and that sort of thing. So how much you can do from a distance with missiles and airstrikes is debatable.
Bloomberg editor Michael Heath there with so much going on. Let's take a look at our futures in Europe opening up the session, and this is a picture after what was a pretty solid day when it comes to broader European and in particular German risk assets in the previous session. You're seeing Euro Stoxx 50 futures up by about 0.25% and some gains for German DAX futures as well. We saw European stocks rising and now potentially rising for a fourth straight session. German lawmakers did manage to vote through a bill to unlock hundreds of billions of euros for defence and infrastructure spending. And remember, this rearmament effort has really been so part of the bull case for European equities and European assets a little bit more broadly. Really, investors seeing that move from Germany as a sign of looser fiscal policies across the region. They're looking now for opportunities outside of the US as well, of course, as that market continues to show signs of slowing. We also saw some moves when it comes to the euro as well, the common currency trading at that 5-month high on the combination of that German fiscal package being approved as well as the concerns over the Trump-Putin talks as well, Paul.
Let's take a look at how energy prices are tracking at the moment. We're seeing oil moving a little bit lower. We've got, this is against the backdrop of increasing tension in the Middle East following the collapse of the Gaza ceasefire. Also, those threats we were discussing with Michael Heath about the US over the Houthi rebels, Iran as well. Well, it appears macro factors around supply are the greater pressure here. Woodmac now sees Brent averaging $73 this year due to OPEC plus production increases, also US tariffs. We did see gas futures slipping as well ahead of those talks between Russian President Vladimir Putin and President Trump, holding on to those declines after, well, nothing really consequential appeared to come from that meeting. Well, President Trump, meanwhile, says he wants to re-establish American energy dominance, and the Asia-Pacific region is emerging as a prime destination for US natural gas exports. Bloomberg New Energy Finance APAC Energy Transition and Trade Specialist Caroline Stroud joins us now with more. So, Caroline, a lot of discussions around US LNG have centered around the implications for trade. The Asia Pacific sees this as a chance to address some trade surpluses with the US. Could we see the dynamics of this market changing a little?
Yeah, I think that's certainly that looks to be the case. I think the U.S. is looking to upend a lot of global trade with the tariffs that they're putting out, and the wave of trade tariffs that have been coming out and being imposed on various U.S. trading partners are causing a lot of concerns among many Asia's export-driven economies, many of whom are increasingly dependent on the U.S. for their export revenues. And so in response, we have seen markets such as Japan, South Korea, Vietnam, India express interest to purchase more U.S. LNG or to directly invest into those projects to hopefully smooth out any tension around the trade surpluses that they hold with the U.S. So at BNEF, we estimate that global LNG demand is going to rise quite significantly. In APAC, it's at the center of that growth. But one thing to remember is that there's a very unique feature about U.S. LNG contracts is that they don't have a destination clause that is buyers of these U.S. LNG can send them anywhere in the world. And a majority of these buyers are portfolio players or traders. And so what we have historically seen is that these cargoes are typically sent to the markets that can pay the most for them. If we look at just Asia itself, there have been many years in the past where they physically receive less volume of U.S. LNG than what the region has contracted for. Instead, they're sending the cargoes to markets like in Europe that has largely commanded a price premium over Asia since 2022. So for the intention of actually addressing the trade deficits that the U.S. has with these markets, it is this lack of destination-specific clause in U.S. LNG that make it necessarily might not make it that effective, actually.
Are there better options for Asian markets?
So in terms of need, there's definitely need. Of course, there are certain markets nuances that we have to take into account. So the two largest markets like mainland China and Japan, they've largely contracted what they need. So there are quite limited additional needs for that. And concerns about a potential trade war, it's going to dampen further gas demands in mainland China. In other emerging markets like Bangladesh, Vietnam, Taiwan, while they have a need, they might face some physical infrastructure constraints into how much they can import. So the more immediate options are perhaps in South Korea, Thailand, India. In terms of need, while they are trying to balance the political pressures to buy more U.S. LNG, there's the economic side of things to consider as well. These are highly price-sensitive markets, and while they want to maintain the trade relationship with the U.S., governments are also very interested in keeping energy costs affordable, and that would naturally push buyers of LNG in the region towards the most affordable and most cost-competitive options. And our current estimate shows that U.S. LNG, even before taking into account of shipping costs, is likely going to be just as expensive as oil index contracts, which already includes the delivery costs that other suppliers here in Asia or the Middle East typically use. So unless the U.S. is able to offer very competitive delivered costs, they might be at a slight cost disadvantage here.
Bloomberg NEF APAC Energy Transition and Trade Specialist Caroline Stroud there. More ahead on the Asia trade. This is Bloomberg.
We think we've been in a rolling recession and that we are actually going to see some negative quarters here. And that's because the velocity of money is collapsing as people, the labor force is worried that, and we're talking about federal, state and local, quasi-government categories like education and healthcare. There's a lot of fear.
ARK Invest CEO and CIO Cathie Wood there speaking to Bloomberg earlier. While next guest runs wealth management business at one of the largest alternative asset managers, Raj Dhanda is the global head of wealth management at Ares. They manage over $480 billion, and it's such a pleasure to have you here in Sydney with us. So Cathie Wood was talking about this idea of the collapse of the velocity of money. She thinks that we're in a rolling recession, and there's a lot of fear out there. What are you guys feeling or seeing?
Yeah, of course. Well, thanks for having me. Good to be here. We have a fairly different lens. If I had to invest in the public markets with all this volatility in the last 6 months, I might feel like Kathy does. Ares manages $500 billion only in the private markets, and we are the beneficiaries of strategies that lend to middle America or the middle of the economy globally, and that gives us a different lens than the Mag 7 dominates trading in the public markets. Private markets have had a very different experience in terms of cash flows of the companies and investment returns from our shareholders.
I do wonder, at a time where there's a lot more volatility, a lot more uncertainty, and clients are probably demanding more data and analysis, does that trend, favourably more towards private assets where there is, typically less transparency anyway, or is there more risk aversion pulling from it?
There's less volatility and more diversity in the private markets today. I don't know that there's less transparency. In fact, many of the solutions we offer today and our partnership with our LPs and investors requires us to have a tremendous amount of transparency. The advantages of the private markets are more driven by the diversification they offer. I remind people 90% of companies over 100 million are private. They stay private longer. So the breadth of the markets is very different than in the public markets. And the investment experience is very different. The correlations aren't there. So you can really construct a portfolio that taps credit, equity, real assets. Today you can build that in the private markets. You couldn't do that 20 years ago. And that leads to a very different outcome.
So you're here in Australia, obviously. What brings you here? And I can only assume it has something to do with, the very healthy pension funds that this country has.
Yeah, it's a great question. Ares has a wealth platform that delivers the best of our strategies, whether it's strategies in sports and technology, whether it's, as I said, credit or equity. And we deliver those strategies to high net worth individuals globally. Last year, 40% of our activities of our fundraising was outside the U.S. So it's a global effort. We have a large team here in Sydney. We're one of the first to invest locally. And the opportunity here is as great as it is around the world. Individual investors have 5 or 10% in the private markets, and the large, sophisticated institutions have almost half allocated to the private markets. So we're here to help them with the how do I do that. The why I should do it has already happened over the last 4 or 5 years, and now it's how do I do that? How do I build that allocation?
Well, there's obviously tremendous opportunity here, but as Heidi was mentioning, that there is less transparency than you get with the public markets. This is something that's on the regulator's radar here as well, the Australian Securities and Investment Commission. They're reviewing their oversight of private markets. Do you feel their concerns are justified, and how do you help persuade them?
Yeah, so as I mentioned, we're a global firm. We work with regulators, many regulators across jurisdictions. And we've been doing this now going on almost 30 years. So our partnerships there are ones that require us to be a strong partner, and we welcome all of the all of that allows us to distribute our strategies to more and more investors, and so we're very open to it. We work globally well with all the regulators and have done it for many, many years, which is not the case for most firms.
The private market space in Australia has really been explosive in growth, as it has been in a lot of places. In particular, regulators here are really kind of honing in on it. Do you share those concerns? I know you already said there's no less sort of transparency or accountability in private markets. How do you address those concerns, though, from a regulatory perspective?
We are trying to help advisors with 3 types of solutions that are in demand globally. They want durable income solutions, they want diversified equity, and then they want solutions in in real assets that are tax efficient. And if you deliver those three solutions to the clients, to the investors, you're able to be a real value add partner. Of course, we don't bring anything to our investors until it's cleared all the regulatory and any of the suitability requirements that are in every jurisdiction that we fundraise.
It's hard not to talk about the sort of geopolitical environment, right? Ahead of April 2nd, more tariff news flow. Are you doing anything in particular when it comes to how you manage portfolios to prepare for that?
So, you know, as I said, Ares is aware of the macro, but investing in the private markets gives you the ability to focus on individual investments. One hallmark of the firm is highly diversified portfolios. So in some of our funds that are, you know, billions in size, the largest single investment is less than 1 or 2%. So diversification allows you to sleep at night. You know, the uncorrelated nature of more middle market strategies gives you the ability to focus just on what the company's cash flows are. A lot of what we do is also in non-cyclical industries. And so it can be hard to appreciate with all the headline volatility that's from the new administration. But if the public markets are essentially back to where we were 6 months ago, or maybe around that level, the private markets have just steadily returned income in various strategies or have found investable opportunities that just sort of grind higher. Compounding is a really, really valuable tool in any investment portfolio, and we like to keep our investors invested in the markets as opposed to trying to time them.
So Raj Dhanda, Global Head of Wealth Management at Ares, thanks so much for coming in today. And we have more ahead on the Asia Trade. This is Bloomberg.
Take a look at one stock that we're watching, definitely trending to the upside when it comes to that debut in Tokyo. We're seeing extending those gains now for JX Advanced Metals there. We are seeing upside of about 6.5%. This is the biggest IPO that we've seen since SoftBank, and really adding some bullishness to this broader Japanese markets there. And of course, we have seen sort of that gain really build over the past sort of hour or so as trading gets underway there.
Yeah, Heidi, you mentioned the bullishness in Japan. We do have the Nikkei better by about 2/3 of 1% at the moment, perhaps in part propelled by a weak yen, 149.57 at the moment. It is, of course, Bank of Japan decision day as well. No change expected today. And take a look at the ASX after early losses, almost flat. That's it for the Asia Trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen.